Hello and welcome to Investor Analytics. In this introductory video about VisualVaR, I'm going to be introducing our new approach to understanding portfolio risk from a visual perspective. So we're going to start with a portfolio that has two investments. The first investment is going to carry a certain amount of risk, call that R1. Let's say it's a 20% volatile investment, so typical stock. Let's say I put $100 into that investment. And so the individual risk of this first investment is going to be $20. The second investment is going to be a little bit less volatile. Second investment, let's say that's a 10% vol investment. You can think of this as a high yield bond, or maybe it's a hedge fund. Now, let's say we also put $100 into that investment, giving an individual risk of $10. So the question that VisualVaR helps answer is, if you combine these two into a portfolio, what is the total amount of risk that you can expect by investing in both of them at the same time? We know the answer is not 30 because of diversification effects, and VisualVaR helps understand what the total amount of risk actually is. So in addition to depending on the individual risks of the two investments, it also critically depends on how they are correlated to one another. So we're going to consider three different cases: a positive 0.5 correlation, a correlation of 0, and a correlation of negative 0.5. So let's look at each of these in turn. In the first case, the VisualVaR diagram is simply drawn as an arrow representing the first risk. There is another arrow representing the second risk, and this one, the length of this one will be half of the length of the first, and it's going to be pointing at a particular angle to represent the correlation. A correlation of 0.5 corresponds to roughly that type of angle, and then the VisualVaR diagram simply completes the triangle, and it's this length, the length of this leg of the triangle, that represents the total portfolio risk. In this case, with 20 and 10 as the individual risks and a 0.5 correlation, the answer is about $26 in the total portfolio. Now, that number changes significantly if you take a look at the same two investments, but let's consider them only having a correlation of 0. In this case, the second arrow for R2 is drawn straight up. That corresponds to uncorrelated returns. And again, the VisualVaR diagram completes the triangle. In this case, the length of this leg of the triangle is only 21. So here we see direct benefits of diversification. You start with an investment that has a $20 risk. You add $10 risk, or you add an investment that has $10 worth of its own risk, but that only changes the total portfolio risk up by 5% from 20 to 21. Now, it gets even better if you look at anti-correlated investments. Here, R1, same diagram. R2, the length will be the same. It'll, as in the past, it'll be half the length of R1. In this case, it's drawn at an angle somewhat backwards. And now you can visually see that this length is materially shorter than it is in the previous two triangles. In this case, the risk is about 17. So you've actually lowered your total portfolio risk by investing in this instrument, in the second investment, because it is anti-correlated, so it's serving as a hedge. So that's the quick introduction to VisualVaR. If you would like to simulate a portfolio and play around and see VisualVaR for yourself, we invite you to visit VisualVaR.com, where you can construct portfolios and see how the risks add or are hedged depending on the types of investments that you choose.